On today's show, 3 questions. Number 1, what are rates telling us? Number 2, what's up with South Korea? And number 3, are screens really the problem?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Will.
And I'm Robbie.
And I'm late. Wait, sorry. Yeah, you are. And I'm late. Guys, chaotic morning for me. I lost track of time. My fault. So we screwed it up. I screwed it up. And Will is only going to be here with us for a part of the time.
We're going to make it happen.
We're going to make it happen. Will's got to go change some lives.
Yeah.
So Will's going to be on with us for a little bit, and then we're gonna let him drop off, and Robbie and I are going to do our best to close the show. We'll see if we can do it.
It'll be a struggle for sure.
It's going to be hard. It's going to be hard. Robbie and I, it always gets kind of awkward. Like I never know what to say to Robbie. It's just like we never know. We just like it's a weird dynamic with us.
Yeah, for sure.
So with that said, let's jump in, Robbie. What are rates telling us?
Rates are telling us a lot, by the way. There's nothing happening in the market, but there's a lot happening with the bond traders. I think you guys can see it, but I posted a picture of the yield curve for bonds. And back in the beginning of the year, actually, let me share my screen so those on YouTube can actually also see it really quickly.
We're on YouTube now. Like and subscribe.
Shout out.
Yeah, let me do this. Okay, so back on January 1st, the rate set by the Federal Reserve has been unchanged. It's still at 3.75 since then. But if we look at different interest rates during that period, the 1-year interest rate was 3.48. The 5-year interest rate was like 3.7. And the most important one, the 10-year, was 4.17. Since then, until as of last night, as you guys can see, the movement in what we call the yield curve is that it's steepened. The drop between the 1 month and like the 1 year has moved upwards. The slope is now upwards, and it's much steeper and ending at higher levels. And this is what we call a bear steepener. The last time this happened during the 2022 year when the stock market dropped 20% and the Federal Reserve was signaling that we are going into a cycle where we're going to be increasing interest rates. 10-year interest rates moved from 4.17 to 0.47. To give you some context, the last time interest rates were 4.7 was at the high of when they were raising interest rates in 2022. So if you look at the 10-year interest rates, they were kind of at zero. The Federal Reserve started raising interest rates. They went all the way up to almost 4.8, and then they dropped back down. During Liberation Day, they spiked up just a little bit. Iran war, they spiked up to the 4.6 level, and now we were back up to the 4.7. And just from historical kind of data or patterns that we see, whenever the 10-year interest rate starts reaching the 5% level, this is very, very bad news for equity prices. Usually that hemorrhages into the market, into panic sell-offs, because now margins are so expensive at 5%, and a lot of people can't afford it. So everyone rushes to close their position. So what we're seeing is that we are seeing interest rates at the high when the last time it was at these levels, the market was bottoming, right? The last time interest rates were at the 4.6, 4.7 level, we were 20% down from the high because the Federal Reserve has been increasing interest rates. The last time it was at 4.6 during like the Iran war, we were down at 12% from the high. And now we're only like 1.5% from the high across major indices, but interest rates are back at that high level, which shows us that now there is kind of disconnection between what the bond market is saying and what the stock market is saying. This has also reflected. Do you guys want me to go into what that means to stocks, or tell you about currencies and then tell you what that means to stocks?
Yes.
Yes. Okay. So what that means... Yes. That means the stock market has a mind of its own and the bond market has a mind of its own. The stock market, as we mentioned in previous episodes, is that it's really carrying itself up by the good earnings that are happening and the kind of frothy environment carried by the tech stocks and the whole AI conversation, right? But we have to keep in mind that bonds are considered smart money and stocks are considered dumb money. So usually when a conversion like this happens, stocks will follow suit. So this doesn't mean that, the bull market that we're in and AI as a narrative is something that is dying. Absolutely not. But throughout the journey,
we can't let Jake be right, Robbie.
We can't let Jake
He
be
tried to
right.
call it last week. We can't let him be right.
Throughout the journey, what will happen is that you're going to see some rotation, some fluctuations within the market. And this is one of their signals. Like, we will see 10% corrections and 15% corrections throughout this time until the whole AI phase is over. And it's going to show up through these different macroeconomic aspects that are happening. So to go back to bonds, why are they going back up? Well, it's mainly because of a lot of borrowing by the AI companies. Now, the US has a competitor. The US is usually the largest borrower, but big companies such as, like, we're seeing the earnings. Google, for example, is borrowing around $500 billion from the bond market. Well, the bond market now, like, bond investors have the option to sell their to buy bonds from Google or buy bonds from the government. So the government isn't the main purchaser that they can control rates. This is letting rates get out of hand, going up for the US government. Also, oil prices. We can't really avoid the elephant in the room. They're fluctuating, but Brent has gotten up to above $100. And that means higher inflation expectations reflected in higher bonds. So what the market is telling us is that we are in this new regime where, just because we're in a technological growth, there's going to be demand for bonds and demands for money in the forms of bonds, which raises interest rates positively for positive reasons. But also, we're in a geopolitical environment where tensions are going to be rising the premium investors require, which will increase bond rates as well. So whether it's good news that's driving the market or bad news that's driving the market, this means that the curve is steepening more and more, regardless of which direction we go. This is a trade. Like, if both sides of the argument tell you, point to the same direction, that's when you enter a trade. So bond yields are going up, bond prices are going to be going down until we move or shift away. I don't know what happens. Inflation readings come in differently. Unemployment readings come in differently. Suddenly the war really ends, or tech companies try to slow down on how much they're raising money to fund these data centers. So until one of these four things happen, there's this new, I would say, regime in the bond market that's going to prevail going forward. If we look at the US bonds compared to the rest of the world and whether this is happening, because the US is shifting in its rates, this affects currencies. And what we have noticed in currencies that validates the story is that the US dollar has appreciated vis-a-vis all other currencies except a few, and I'll talk about the few in a second, which means because now the interest rates in the US are higher, the curve steepened, it's more attractive for foreign investors to invest in the US dollar. So they've been buying dollars to invest in the treasury bills. This made the US dollar be higher than the appreciate versus the British pound, versus the euro, versus the Swiss franc, versus the Canadian dollar, etc. The only currencies where the US dollar wasn't able to appreciate higher than them were Australian dollar, New Zealand dollar, and Norwegian krone. And these three are all main exporters of oil. So what is happening is now money is flooding to the US because that's safety, but it's also flooding into countries that are making more money because of higher oil prices, but are also safe. You notice that the currencies of like Russian ruble, etc., they remain fixed. But New Zealand dollar, Australian dollar, Norwegian krone, countries that export oil and are safe from geopolitical tension, have appreciated. So this is a new macroeconomic regime, and we're kind of stuck in this regime until one of these four factors that we mentioned kind of gives us an off-ramp out of this position we're in. Higher bond prices means probably slower economic growth for the short time being, and pressure on equity prices. But this is where we stay. This is the new Goldilocks zone.
Robbie, can we just back up for 1 sec? Is it one easy explanation or one of the reasons why like a higher 10-year yield can hurt equity prices is that as simple as saying, because there's an alternative that's safe and has higher yields, that people will turn to bonds and out of equities. It's just a reallocation of assets.
100%. Now
Okay.
you have other options on the table to invest in them. 5% in a treasury, assuming inflation goes nowhere. That is a safer 5%.
That quote unquote
And you
riskless return.
You can lock it in and guarantee it for a certain period of time.
Yeah.
Exactly. That's
Totally
one.
makes sense.
Two, well, the only way we can identify what the stock price is that we take expected future earnings and we discount them based on interest rates. So when interest rates go up, that means stock prices on pen and paper, according to the formula, will be lower. So that is also another reason why equity prices go down as interest rates go up. And then there's the more, common sense reason, but it doesn't always happen, is that now if the company wants to borrow money, it has to borrow at a higher rate. This recently
Squeezing
happened.
Profits, yeah.
Exactly. This is recently happened with Meta. They rose money a couple of months ago at like 7%, and now they want to raise from the bond market, and now they want to raise new money from the bond market, and they're raising it at 7.5. So only there's an extra interest expense on the income sheet of Meta at that point due to higher equity prices, which lowers the stock price.
Yeah, that makes sense. Will, anything you want to add on this?
No, it's interesting that there's like Robbie said, a handful of things causing this, and they're all kind of like converging to give us the same outcome. But like you said, there seems like there's a couple of off ramps as well. It seems like we've kind of been stuck just in this like, are we in a war? Are we not in a war zone? Right? For I don't know, months and months. And every time we it feels like a pump fake, and yeah, we're bombing Iran, and it like the market has just been really jumpy. It feels like. So I don't know if the off ramp is part of that. I would assume oil goes along with that, and the straits open or close or whatever. I think that geopolitical side is obviously a big deal, and then I'll be curious to see how the new Fed reacts to this. And
they're meeting in 5 days.
Yeah,
they're meeting in 5 days.
To see.
But who's counting, Robbie?
Robbie's got it. Yeah.
Robbie's got it dialed.
He's got a movie theater rented out with popcorn.
It's going to be the only person there. I'll be there with you, Robbie. We can share some. We can share some.
Be kind of electric. Yeah.
Yeah. I also, last thing on this, and we'll move to Will's topic, but we want to be careful, right, Robbie, in the sense of people clinging on to things like we haven't seen this since, and it's like one factor, one thing that in a multitude of different things. Like when we see a lot of articles that are like, we haven't seen this metric since 0809, or we haven't seen this metric since 2022 or 2022. I just want to take a step back and get your thoughts really quick on, we need to be careful of taking that too far where people like cling to that and say, well, this must mean A plus B leads to C, D, E. Like, it's not that simple. It's just one factor. Do you want to speak to that for just really quick?
Yeah, no, 100% agree. The world changes and the way we conduct business changes. The longer the period, this is where the irony happens. The longer the period is, when they tell you this hasn't happened for 100 years, then this is going to be much less accurate than when they tell you, oh, we haven't seen this for the last month, but it happened a month ago. So the closer the window, then yeah, probably from last month until this month, nothing changed on a macroeconomic level or the way we live our lives. That the indicator might still have some signaling power, but the longer you go back in the past, the weaker that indicator happens, although the headline becomes more eye-opening, which is, absurd at that point.
It is. Okay, awesome. Well, let's jump to Will's topic. What's up with South Korea, Will? What's the good word?
Something's going on in South Korea. There's something in the water. The people are going crazy in the stock market. So just to kind of give some color to this, the theme of this conversation is diversification, and it's going to hit us also. I mean, it's kind of been this new, interesting last couple of years where all of these large companies have grown so much that diversification, we preach diversification, but it's actually gotten, I would say, even a little harder to diversify because most of our index funds that we buy for diversification are now concentrated. Well, the story's no different. In fact, it's very much magnified in Korea. Everyone knows one of the companies that makes up most of the Korean stock market. And then there's another one. So Samsung and what's the other one? SK Hynix, both semiconductor companies, both chip making companies. make up over 50% of the Korean stock market. So if you're buying a Korean index fund, South Korean index fund, you're basically buying 2 companies and some other small companies. What that means is those companies, we all know that semiconductors have been going crazy. Those Korean stock market has been just on an absolute heater, both up and down, and mostly up. Like this year to date, as of 2 weeks ago, it was up 90%. The Korean index, right?
Basically one stock.
Yeah. Yeah. 2 stocks. Yeah. Samsung and SK Hynix.
Yeah.
So the Warren Buffett quote is, you don't find out who's been swimming naked until the tide goes out. And
I love those guys, dude. They're so great.
So good. So the reality is it came to light that because of, I think it's probably due to home country bias, lots of South Korean retail investors have been investing with like heavy leverage in their home country index and stocks, buying
in their
Samsung,
2 stocks, yeah.
in their 2 stocks. And so it kind of came to light, and the Financial Services Commission in Korea announced that they're tightening deposit requirements on margin, basically effective July 31st. So like in a week. So it's triggered this like massive sell-off of these positions because they're basically realizing the Financial Services Commission of Korea is realizing like there are so many retails with like unbelievable leverage at this like 90% peak. And so I think they're like, we got to do something about this. Also said, they have this thing called a sidecar, which is a circuit breaker. Korean trading halts have called sidecars to kick it automatically when selling gets too violent. In 2026 alone, they've triggered close to 30 of them, plus multiple full circuit breakers, more than during the entire 2008 financial crisis.
Wow.
So it's just this like insane market in Korea based on these 2 semiconductor stocks that have gone kind of nuclear. The market was up 90%. The South Korean market was up 90% 2 days ago, or like 2 weeks ago. And it's down 30%, and like
wow.
over the last week, basically. So a lot of these margin calls, a lot of this leverage is happening, and that's where you find out who's swimming naked. Is a lot of these people are getting margin called, and it's just causing this vicious cycle. I just think it's interesting, and it's obviously the case. Just so Robbie, it's 30% of the U.S. stock market is in big tech.
In the US, probably 38.
Yeah.
Yeah,
So, I mean,
it's close to 40% now.
So that right there is kind of like this is like South Korea is a microcosm of what it feels like the US is headed towards a little bit, where we just have this interesting diversification play where the big stocks, the big tech, Magnificent Seven, semiconductor stocks that are all growing are kind of determining the peaks and valleys, right? When earnings come out or when these companies have a bad day, you're going to see the entire diversified market. Now, what does this mean? I'm curious to get your take on this, Robbie. Like, what do we do about this as investors who want to stay diversified?
Well, here's the thing. When you're buying an ETF that tracks the Korean stock market, every ETF says some rules for it. And a lot of the good ones, at least the ones that I know we're invested in, have hard breaks on what is the maximum allocation in a single security. So, for example, one of the ETFs says that if a security becomes more than 25% of the index, we're going to cap its weight at 25% of the index and refunnel the stocks into the other part of the other companies in that index. So here's the thing, just the fact that naturally, organically, the market has become concentrated, this does not mean that the ETF you're investing in can't have some railways or kind of fences that further protect you and protect your diversification as a retail investor. There are more like practical stuff that you could do, and you would break up the index, and instead of just buying one ETF that holds all the companies together, you would break up that level and buy the ETFs of every single country, and you play with the weight to ensure your diversification is there. There are tools at your disposal. Just the fact that a certain market became very concentrated does not mean that your portfolio has to become very concentrated. You just need the know-how for how to make sure the money is still spread across multiple baskets.
What's interesting about this year, you talked about like the Mag 7, and there's been so much talk about the composition of the Mag 7 and the S&P. But what's crazy this year is this separation of the Mag 7 actually doing really poorly
compared to the rest.
Compared to the overall, we talked about this recently, Robbie, the S&P 493, basically everything minus the Mag 7. And it's just interesting to see that that separation. We've also talked about how this is why we don't believe in just an S&P 500 set it and forget it strategy or any index. Like there's a lot more that goes into it.
Sure. Global diversification across your entire account with multiple countries, companies, currencies is not just the same as picking the S&P 500 or picking the Mag 7 or picking NASDAQ or, a tech sector. It's just volatility is kind of the price of admission in the stock market you can, like all these Korean leverage traders, it's like you only think about the upside, but the downside is just as magnified, and you can get just as, obviously even more in trouble with with not having enough diversification. And then on top of that, having leverage. We're never proponents of leverage, but it's just something that it's scary to see that like lives can be ruined just by treating the stock market like a casino.
Yep.
And this is why we preach the hare, the tortoise and the hare, and we're the tortoise, right? We want it to just be slow, steady, easy, predictable. There is going to be volatility. Again, that's the price of admission in the stock market. You have to be okay with that. And it's been volatile recently. It's like bigger swings. It feels like a full percent each day rather than just little swings.
Yep.
So it's just funny. It's funny to watch and see. In the short term, we talk about it on this podcast. We care about it. Long term, we'll zoom out and everything's going to be fine.
I heard on Morgan Housel's podcast this morning, someone wrote in and basically was like, hey, in a world of more financial education than ever before, and we have more information and indexing's become such a big thing. Like, do you ever see a world where like we don't have these massive swings and people just all kind of get it and all of a sudden returns are gone because everyone's just indexing? He basically said what we know, which is, no, that's never going to happen and this is yet another example of we have the wiring in our brain to be susceptible to greed and emotion, and that will never change, ever. Change. There will always be a cohort of people, including us, by the way, we all fall prey to this. There will always be. You
could have the most diversified portfolio in this most standard index and still have to deal with all that.
Yes. Yeah. And there will always be human nature that drives this. And so This is just another example of that. So, Robbie or Will, anything else to add to that?
No.
Be careful out there.
Yeah. Be careful out there.
Be careful out there.
In South Korea.
Right. Will, unfortunately, we got to let you go. You got to go get on a meeting. I wish you could stay because I really want your take on this last segment. This is totally my fault for being late.
Okay, adios.
We'll let you drop off, Will. Thanks for being here. We love you. We're going to miss you. Robbie, now it's just you and me, my guy. Oh. What are we going to talk about? Oh my gosh, I don't know. So this last part here, our screen's really the problem. This might be a conversation, truly, we get Will back on, we get Jake back on. I think this should actually be a killer, just like overall panel discussion with our team. But first of all, shout out to Becky. I always want to take an opportunity to shout out the people on our team that aren't out in the public eye, that are like the backbone of our team, Becky being one of those main backbones, and freaking love her. And she will find articles and things just throughout the week and be like, hey guys, how's this? You should think about this for 2 cents. And she did that this week. She did this yesterday, which I thought was awesome. And I do think it's worthy of a discussion for sure. So again, coming back to this idea, the main idea being our screen's the problem. There's been so much talk in society around screens, me having young children. I'm very, very, if you don't know this, Robbie, I am like very strict on this. I'm very weird about screens with my kids.
Do they have like their own iPad or cell phone?
So my kids have iPads, yes, but I have very strict rules around them. They don't use them really ever during the week. The only time my kids can use their iPads, like on road trips or on a plane, if we're traveling, I kind of let them indulge in an iPad, on screens. That's really the main thing. Sometimes, like maybe once a week, I'd say on average, I'll let them do what we call like quiet time, or like in the afternoon after we've been outside and doing stuff, especially in the summer. I'll let them like for 30 minutes play on their iPad, but it's pretty rare. I'm very strict. And one thing I will never, ever allow them, and I've never, is like let them have my phone. Ever, ever, ever. And zero judgment, by the way. This is always a tricky topic because I don't ever want parents to feel judged by like my weirdness or my rules. And, that's always kind of a weird tension when you're talking to friends or my siblings or whatever. I'm just weird about it. Like I never let my kids have screens at a dinner table, at a restaurant, ever. They never have my phone. I'm very, very weird about it. I'm very strict about it. We digress. The idea behind this article is like, this is a huge topic, especially with just how prevalent screens are today. And I think what the article challenges is this idea that the main reason we have a rise in like anxiety and issues with kids, be like the main idea of like, we blame screens for that. This article brings up, kind of a counterpoint or something else to point out, which is specifically the economy. And so I want to talk about this for a sec. So I'll just kind of break this down. So again, we tend to blame screens and social media for rising anxiety among young people. This new study suggests that something deeper might be happening that has led to this. And the main thing they talk about in this article is not necessarily anxiety. What they highlight is what they call perfectionism. So the rise in perfectionism among young people in America, and specifically around what they're calling socially prescribed perfectionism. So the belief that other people expect you to be flawless. So the researchers looked at nearly 83,000 college students from 1989 through 2024. And so again, focusing on this rise of perfectionism. So it's this feeling that mistakes are unacceptable, falling behind is dangerous, your worth depends on your performance. First thing I'll say on this, Robbie, I think this is the reason I think we want to talk about this is I think this is really, really prevalent in dentistry.
Yep.
Because dentists, to get to where you are at a baseline, you have to be exceptional compared to your peers. You just have to be. You're ranked. You're always comparing yourself throughout school, after school, after you graduate. Dentistry's small. Dentistry's really, really small. So I think this is really pertinent among dentists. So the study found that perfectionism. So again, we blame screens and social media for this, which I think absolutely needs to very fair. And if you look at anything like Jonathan Haidt's work, he's got a lot of compelling data around this with young people and like the rise of social media being in lockstep with the rise in mental illness and all the struggles and anxiety among kids. But this study found that perfectionism tended to rise alongside economic stagnation and income inequality. So basically saying the possible explanation they're saying is simple. It feels harder to get ahead. The cost of falling behind feels higher and people respond by pushing themselves harder. So the message basically becomes you don't just need to work hard, you need to be exceptional. So I'm going to stop for a second, Robbie, and get your thoughts before we go any further on this. Just what's your kind of idea or thoughts around this?
My brain is calculating. And really what came to mind here is like, are we mixing correlation and causation? This is what is the first thing that came up. Absolutely, definitely. The comparison and being put in a competitive environment induces anxiety and stress. Absolutely. But isn't that healthy anxiety and stress? This is what I thought of. But social media itself, it's been proven that the way the apps are designed and the websites are designed and the fact that they put you in a loop of doom scrolling that rewires how dopamine is released in your brain are actually physiologically damaging and trigger anxiety more than ever. Is it the only thing that's triggering anxiety? I don't know. In my mind, here's what I think causes anxiety is one, just being overwhelmed and not able to carry. You know what Jeff Bezos says, that things like, when you put something off that you should be doing, that's when, like, having a lot of work isn't stressful. Putting stuff aside and keeping them in the back of your mind that you want to do them is what's stressful. So just how fast-paced the current world is I think what causes stress, and the lack of community to be able to tackle these is what causes stress. This is my own theory of my own stress in life, but it could be that it is screens for other people, and it also could be that competitive environments are what causes stress, just not in my book personally.
Yeah. Totally agree. One of the things this article pointed to was you can't blame screens and social media because the rise of perfectionism has been happening prior to that, is what the argument is. But my take is, yes, and it's really, I think it's really hard to not blame screens and social media for maybe not creating this, but certainly amplifying it and making it far, far worse. The other thing that my mind went to, Robbie, and I'm not saying this is at all correct, but I definitely went, like, my first thought was not only the causation and correlation situation, but also, is this reverse causation? Meaning, we're saying, or the article is arguing, that income equality is creating perfectionism, but is it not possible to make the exact opposite possible connection? Meaning, our drive for perfectionism, whether that be from parents or whatever it may be, is causing income inequality?
Well, it is.
And then it feeds on itself?
The biggest feature of a capitalist system is that resources are allocated to the most efficient output, right? And if the most efficient output in terms of a human being is the one who perfects their work, works on their craft, creates more value to other people and betters their life, whether it was helping them with their mental health or their teeth or with their financial situation, then they would accumulate money. Then the income inequality and wealth inequality is just a feature of how that wealth is allocated inefficiently. So I think this is just, are we now being kangaroos, jumping to conclusions and saying, oh, capitalism causes anxiety? I don't think so.
Yeah.
We can't really just go there. Really.
Yeah, for sure. And I genuinely don't know this, Robbie. You can speak to this far better just from, I'm sure you just have this locked and loaded. But yeah, are we truly in unprecedented times of income inequality? Is it?
No.
That's kind of my take, is I don't think we are. Like, I think income inequality at other times in history was far worse than it is today. But is that not a fair take?
No, it is fair. There's a big difference between income inequality and wealth inequality. Income inequality is what is your disposable income after you've been taxed, regardless of how much money you make. And this is measured by something called the Gini coefficient, right? And you can read it. The US kind of ranks in the middle across different countries around the world because we have a progressive tax rate. The higher income you make, the more tax it'll be. Your discretionary income, the gaps between you and someone in a lower tax bracket isn't as severe. The issue for the US is wealth inequality. Obviously, you've got a trillionaire in this country and a bunch of multi-billionaires, along with the new middle-class millionaires, and then the rest of the population who are struggling. So there is a lot of wealth inequality in this country, and it is bad. But I don't think, and usually wealth inequality shows us, like if we study history, wealth inequality shows up in phases, and that creates usually populist movements, and then politically the wealth is redistributed. Think of, what was that president in the 20s? I know his name, he's the boxer. Roosevelt, the first Roosevelt. Yeah. Right? FDR. So he went after the big companies where wealth is concentrated and kind of redistributed. Wars redistribute that wealth, etc. So in history, there's always been times when the wealth gap expands, and then external factors, whether they were military through wars or technological, where new millionaires get created, like in the technological revolution of social media and the internet, or whether it was wars that redistribute that wealth. But if you want to compare the extremes back to previous periods, no, absolutely. Well, although we've got a trillionaire, I don't think the wealth inequality is larger and impactful on life as much as it was when we were under monarchies or when we were under empires, where one single family owns everything and you're literally useless.
Yeah. I mean, that's kind of where I have a hard time, I think there's some validity to this article, but I also think there were some reaches, in my opinion, around letting social media somewhat off the hook and being like, no, this is an income inequality problem. I'm not saying that's not true. That's not part of it. But I just have a hard time with this idea that I think it's never been easier today, ever, over the last 10, 15 years, to expand your reference group. And this idea of what used to feel like I was doing well because my reference group was just my neighborhood or my friend group, or my classmates in dental school, whatever, is now Kim Kardashian.
Yep.
Or the Prince of Dubai, or, I now have access to these random people, which, by the way, a lot of this stuff is just completely fake and manufactured. I just have a hard time, maybe just intuitively, and maybe it's bias. Maybe I'm like falling prey to biases, but I'm just like, I don't think it's as bad as what we claim it to be, as far as I think the data would show that the regular person today is doing far better by objective measures than the regular person 25 years ago, 30 years ago, 50 years ago, 100 years ago, even if the top of the top are doing exponentially better as well. Does that make sense? Like, I just don't think the gap is as wide as we claim it to be. It just feels that way because of social media.
Yeah. No, what you're saying is that the median, or like the halfway throughout every single year, has been trending higher, although the gap between the top percentile and lower percentile has been wider. This is true. I would do the mental exercise of let's think of an economic system where there isn't a lot of wealth inequality and income inequality, which are not a lot of systems out there, right? But it's usually non-capitalist market systems that are rare in this day and age. And you would see, is anxiety in those countries increasing as well? And that's a valid economic questions, and I'm sure there are articles about it. My hypothesis would be that no, anxiety has still been rising regardless of the economic system that you live in. We can think of Scandinavian countries where they adopt a more of a social democracy type of economy. Those people, yes, they rank higher on the happier scale, but this does not mean that they don't have anxiety, and anxiety is not there. I'm not saying it's not a factor, income and inequality, but it's not as big of a factor and doesn't have a bigger coefficient as much as social media does. This is, I think, where I would land.
I think that's where I would land as well. That's exactly what I took away from this is you can't blame one single factor. It's like, it's not just social media. I agree with that. There's other factors, maybe like what's happening with income inequality, wealth inequality. But if you had to rank, in my opinion, if someone said you have to rank the number one reason why we have, by every objective measure, and this is just true, by every objective measure, as a population in America, we are doing better than we ever have economically. That's across the board, but we have never been more unhappy. If you had to rank what are the main culprits of that, I think social media by a wide margin. Would you agree with that?
Yeah. And not only social media as a product itself, although there is a lot of arguments to there, but what you are losing by spending time on that social media. So that is where it happens, because what we're putting aside to use social media, what we are lacking is what actually was great for our mental.
Yeah. So true. And I think the main takeaway here, if there is one, it's maybe a reminder, and we talk about this kind of stuff all the time, but a reminder of it's never been more important to have an internal scoreboard in your life, or this idea of like, what are you? I don't think comparison is a bad thing. I really don't. I think comparison actually, if harnessed properly and used properly, it's like anything. It's a tool. It's something that if you harness it correctly, you could argue that it's one of the factors that lead to progress and innovation and driving us forward. And you can harness that in your own life. I just think it matters, like, what are you comparing yourself to? What is the reference group? And I think the reference group should start with yourself and your personal pride. How, who was I yesterday? Who was I last year? Not to get all cheesy, but I think it's true. Like, I think it's never been more important to focus on what are you actually comparing yourself to. What are your thoughts, Robbie?
100%. No, I completely agree with everything you said here. Yeah.
Was it? We mic dropped it.
We mic dropped it.
Awesome. Okay. Anything else you want to add to this, Robbie, or anything we didn't cover? I know we had to rush the first two somewhat to get Will out of here, but anything else you want to add?
No. This is great. I wonder if there are going to be counter arguments for the article and our opinion. So we'll just address them next week if people email us.
Honestly, I hope there are. I truly do. I always want to be pushed back on, and I hope it never comes off that we have all the answers or we know the truth here. All of this is subjective, a lot of this stuff. And that's the whole point, is to have these different opinions. So yeah, absolutely. If you've got a counterpoint to this, you can actually email us at podcast@dentistadvisors.com, and we'd love to hear your take. I actually think this was maybe a teaser to a bigger discussion. I would love to take this and have a bigger discussion, maybe like a panel discussion with the other advisors, and go over this. So, okay, for now, Robbie, thanks for all your words of wisdom. Everyone, if you're still listening, thank you for listening. We appreciate you. If you are out there listening and you are thinking that it's time, you need help when it comes to your financial planning, your tax and accounting, your insurance, whatever it is to do with money, there's got to be something, we all have them, that you've been putting off and need help with. You can go to dentistadvisors.com, click on the book free consultation button. We are happy to help. We want to hear your story, see how we can point you in the right direction. We'd love to talk to you. So for now, Robbie, thanks for being here, sharing your words of wisdom. Will, thank you as well. Had to drop off. That was our 2 cents. Till next time, have a good weekend, everybody. Bye-bye.